Hi, everyone. So, this is the third installment of our video series on rescue capital. And what I'd like to walk you through here is an investment on, let's just say, an apartment complex called the Elm Street Apartments, and what to look for. What are some of the critical aspects of making investments like these? What kind of a situation creates these types of opportunities? And I think this is very relevant in terms of what we're seeing in the market. We're also continuing to see a lot of different aspects of different types of debt as they're coming to maturity and as interest rates have climbed up on floating rate debt. It's certainly creating a lot of these types of opportunities. So Elm Street Apartments, 150 unit complex, purchase price of 12 million, 1.8 million in equity, and 10.2 was financed at a floating rate debt of 5 point, or let's just say 5%. Fed continues to raise the rates, and that 5% interest rate climbs to 7%. And what that does is it increases the debt service by about 20%, turning the property cash flow negative. And so you've now got a situation where, let's just also say, to make things interesting, regional dynamics, cap rates, don't do what you're expecting them to do, and all of a sudden you've now got a property that's worth 9.5 million, and you're underwater in terms of what's the original investor is underwater and is dealing with occupancy issues of 80% and is cash flow negative. So when you bring in their options are either to look for rescue capital and get the property stabilized that way, or to risk foreclosure. And so rescue capital can be a much less expensive way to stabilize an asset. I think you stand to lose a lot more if the bank was obviously to foreclose. And so what would happen in this type of situation is the rescue capital investor comes in and invests $1 million and takes 30% of the cash flow and 30% share on the gain as the property continues to stabilize, and the original investor retains 70%. So instead of getting 100% of the loss, they're getting 70% of the benefit. And the subsequent investor, the rescue capital investor, is getting a 30% share in that. Now you take the $1 million. Let's just say that a half a million of it, for example, goes to debt service payments, and 300,000 goes to property improvements. Maybe there was some deferred maintenance because the property wasn't making cash flow, and then let's just say another 200,000 is allocated for leasing and marketing. Occupancy climbs up from the 80% to 92%, and you're able to get restored cash flow, and the complex turns cash flow positive. And you've got let's just say a 3-year window on this, and the property starts to appreciate because it's now performing better and it's got higher occupancy. And as things continue to progress, the asset is now worth, let's just say, about 13.5 million over the 3-year run, with a 5% appreciation through that time. So as you look at the gain, now you've all of a sudden got 9.8 million in remaining debt, and net proceeds on the sale are 3.7 million, and the original investor gets 70% of that, which is 2.59 million or 2.6 million, and the equity investor at the time of the sale gets 1.1 million. Not to also discount the fact that there's a few $100,000 of cash flow throughout the duration of 3 years or 5 years, however long that time window turns out to be before the sale. And so what you've done is you've shared the equity, and there's been some dilution to the initial investor, but you've got shared upside, 70-30 split on the upside, and a significant return on the rescue capital invested. And you've got that rescue capital has also done the second thing, which is to stabilize the cash flow and get the unit to where it goes from cash flow negative to cash flow positive. And then you've got the ability to buy time and do a strategic exit. One thing I'll also mention is not only would the rescue capital be used to stabilize the unit, but you've also got an opportunity with the ability to buy time, quite literally, with rescue capital, to be able to refinance at a lower rate fixed rate debt. as opposed to the original floating rate debt. So we see a lot of these types of opportunities, and they can certainly be very, very powerful in terms of just a small infusion of cash that can go a long way to rescue an asset and get it stabilized. I think again, I'll leave off where some of these fundamentals are: underwriting it well, understanding exactly how much will that rescue capital, whether it's a million or 2 or 5 million, whatever that number is it really going to be sufficient to be able to stabilize the debt service? And is the deferred maintenance, fixable, or are there deeper issues? So that's all good underwriting. And then the ability to get occupancy back up. Sometimes it's not just financial, but it's also changing the asset manager, the property management teams, et cetera. They can all be contributing factors. So obviously a multi-pronged approach: financial, operational, and also looking at the marketing and leasing aspect of it are all critical. At the same time, making sure that the asset is sound and in obviously good markets. So I really wanted to share this with you. I think there's a number of things that are key takeaways as it relates to finding these types of opportunities. They produce a lot of significant return. Just the 1.1 million on the 1 million example that I shared with you, not to mention hundreds of thousands of dollars of cash flow from the duration of the rescue capital period. And then you've also got the ability to over allocate the rescue capital because you're effectively buying the units again for $1 million. So a lot of times in rescue capital scenarios, you will see 200, 300, 400% plus, sometimes even more than 400 or 500% in tax deductions. So $100,000 could produce a $500,000 accelerated depreciation loss on that given year's tax return. So a lot of things to think about. I would love to get your feedback on these, and like I say, subscribe to the news series, the letter series on the 22 essential commercial real estate topics. And as we bring out deals, happy to share them with you, and would love your comments and feedback on this video series. Thanks again for watching.